If you followed the news recently, you heard about a massive promise to working Americans: no tax on tips and no tax on overtime. But if you look closely at the new law that actually passed, your tips and overtime haven't suddenly become 100% tax-free. The law actually created a specific tax deduction. This diagram shows the difference. An exemption is like a shield. It makes the income completely invisible to taxes. But a deduction is more like a coupon. It shrinks the pile of money the government can tax you on. Even after that pile shrinks, payroll taxes for Social Security and Medicare still apply to every single dollar. So while the headline sounds simple, the amount of money that actually lands in your pocket depends entirely on strict deduction math. Let's look at how the tip deduction works. First, your job has to be on an official list of customarily tipped occupations. Second, you can only deduct up to $25,000 a year. This flowchart shows how that translates into real dollars, using Maria, a waitress who reports $12,000 in tips. Because she is in the 12% tax bracket, her deduction saves her 12% of that $12,000. Her actual savings is roughly $1,400. Now watch what happens when we apply this to Devin, a bartender earning $32,000 in tips. He hits that hard $25,000 ceiling. The extra $7,000 above the cap gets taxed exactly like it always has. Then we have Renee, a banquet worker. Her restaurant automatically adds an 18% service charge to large parties. Because the customer doesn't choose to leave it voluntarily, the IRS treats it as a mandatory service charge, not a tip. Renee gets zero deduction for that money. The tip deduction offers real savings for people receiving standard, voluntary tips, but it strictly filters out mandatory service charges and caps the benefit for the highest earners. Overtime rules are even more specific. While a single filer can deduct up to $12,500, the law is very particular about which hours actually count. This diagram shows how your overtime paycheck is split. Let's say James is a nurse earning time and a half. His regular base pay is taxed normally. Only the extra premium, the half portion on top of his base rate, qualifies for the deduction. That premium also has to be required by the baseline federal labor law, or the FLSA. Think of the FLSA as the floor, the minimum standard for the whole country. Carlos earns extra overtime because of a union contract or state rules that go above that floor. Since the federal government didn't require that extra pay, it stays fully taxable. And remember, because this is a deduction based on your tax bracket, workers earning lower incomes will naturally see a smaller dollar amount in savings than workers in higher brackets. To get the overtime relief, your extra hours have to meet strict federal definitions, and your tax bracket determines the final value. Even if you navigate all the federal rules, you still have to look where you live. Several states, like California and Colorado, have opted out of these new federal rules. In those states, you still pay full state income tax on every tip and overtime hour. You also won't see this money in your paycheck right away. For the 2025 tax year, you claim the deduction when you file your return in early 2026, meaning it shows up as a single refund. It won't be until later that the benefit gets built into your regular paycheck withholding. Because the law passed mid-year, 2025 is treated as a transition period. The IRS will not penalize employers if their initial reporting of these numbers is imperfect while they adjust their payroll systems. But by the time you receive your 2026 W-2, the reporting will be strict. You will need to look for Box 12 Code TP. That specific code is what proves you have qualified tips to deduct. Claiming your money means understanding your tax bracket, checking your state laws, and ensuring your employer classifies your pay correctly. If you want to understand exactly how the tax code affects your wallet, subscribe to Easynance. We translate the fine print into clear strategies you can actually use.